Hello and welcome to Talking Technicals. On the show today, we will spotlight some interesting market formations and gap trading strategies. We will compare and contrast directional trading with range trading and the all-popular day trading. Dr. Narayan, our show expert, will guide us through all this. An analysis of our markets indicate that we have plenty of day traders and short-term players, and they attack the market very differently from long-term investors. In fact, the same price action may induce one to buy and the other to sell. And how does this work? We will find out. But for now, let's start the show with a fun question. What is a dead cat bounce? So that's the question, dead cat bounce, and there are some options for you. Is it a price movement that indicates a rising stock that shows a temporary decline, a reversal of a declining stock to a sustained uptrend, a declining stock showing a temporary bounce back before declining again? You need to figure out which of the three options is the right answer. Give you just a couple of seconds for it, and the right answer actually is option C. When a stock steadily declines for a long time, say over a couple of weeks, traders may view it to be oversold, or you might either be covering your shorts or you might be initiating long positions, and this causes the move, which then fizzles out very quickly, showing a false recovery. So let's take a look at this dead cat bounce on the chart stock.
Yeah, the dead cat bounce is an interesting term which actually emerged from sort of a setup wherein you have an event which precedes a fall, right? Now, the key thing to note here is that the trend has actually already run out prior to the fall. And then what you have is a sharp fall and a small rise, which is what we call as being a dead cat bounce. Now, we call it a dead cat bounce because you have a cat which is already dead, and now it's falling down on the floor and just sort of having a small upside bump, and then it again goes down. Now, if you see it on the chart, you'll always label something as being a dead, let's say this portion of it, or let's say this portion of it. Both of these will be labeled as being dead cat bounces, mainly because you have a very sharp fall, which typically is always accompanied by an event, and that event is what sets off this. And because the event is in play yet, these sort of small rises will remain small and then will be again followed by more declines later.
But the interesting thing about dead cat bounce is that the short-term trader and the long-term investor would play this diametrically opposite. That is, one would buy into the dead cat bounce while the other one would actually sell. Right, Doc?
Yeah, that is true, because and I would like to illustrate this particular thing with chart of Infosys. Now, if you look at the intraday chart of Infosys, here is the day of the results when you had this very sharp fall, right? This is where the trend has sort of run out already, and this is the onset of a decline. Then, during the next set of hours, this is an intraday chart of Infosys, by the way. During the next set of hours, which lasts for a few sets of days actually, you have a slow and gradual pullback, but then this generally comes up to fill the gaps which are left on the way to the downside. Once the gaps are filled, the prices again move a little lower. Now, based upon how large the fall is, intraday traders could actually look to go long here and try to sell off on this rise. But if you're a holder or a positional player, then you would actually wait for the rally to complete and then seek to sell it off here if you're a holder, or to insert a short somewhere out here where you will define a resistance point. The closing of the gap is a decent resistance point. That is where this rallied up to, and then you can see for yourself that the share has actually moved down much more.
But still sticking with the dead cat bounce, the term gap down opening comes up for inspection. Gap down opening basically is when a stock opens at a price which is lower than the previous day's close, and if it opens below the previous day's low completely, it's a full gap down, and for day traders this actually spells a trading opportunity. Let's look at one.
Well, I'll say gaps could be on both sides, not gap down. You can also have a gap up. And the most ideal place to look for gaps would be the Nifty chart itself. And in fact, traders, particularly day traders, are extremely vexed about how to deal with the gaps. Now, here's a chart where of your Nifty intraday, where you can see here is an opening gap, here is an opening gap, right? I'm sort of putting up arrows where there have been a lot of opening gaps. See the various occasions when you have a series of opening gaps for the Nifty. Now, you will have to deal with the gaps in a sort of different way based upon whether the post-gap movement actually goes in the same direction of the gap or it actually chooses to reverse from it. And the trading strategy in this will be very, very different. This is something that I am advocating for a short-term trader or let's say a day trader. When you have an upside gap like this here, what you need to really do is look to go long on this if the prices were to exceed the first bar up. Now this is an intraday chart, this is a 15-minute chart. So the first bar here or the candle here is actually a 15-minute candle. If you want to be more aggressive, you can even use something like a 5-minute candle. Now here is a 15-minute candle. You will go long once the prices clear the top of the 15-minute candle with a stop loss placed below the first 15-minute candle. So you have your stop in place, you have your entry price, and for the rest of the day you will have an upside movement.
So that's on the candle you're looking at the open and close of the candle, or the high and low of the candle?
The high and low of the candle, right? So you enter above the high of the candle in an upside gap bar, or with a stop placed less than the low of the candle. Right now, if you go along here is another example of the same thing, right? It had an upside gap open. You place a buy order above the high of the candle with a stop at the low of the candle, and then you had this nice uptrend which has ensued.
And so before we go to the next one, Doc, just very quickly, where do you get out of this trade?
See, moving out, this is a day trading strategy, right? In a day trading strategy, you'll have to take sort of a discretionary exit. If you're happy with the profits, that's the time to exit. So for a day trader, you don't really have so much of a target-based kind of thing. You just need to have very good fail-safe or low-risk areas of entry. I think upside gaps which see a follow-through will give you that low-risk entry point. And during the day, you could look to exit wherever your profits are fairly decent for you to take it off. Or of course, if you have some other things on your charts in terms of a resistance level, etc., there also you could take the trade off. Here is an example where the stock actually gapped on the downside, right? Now again, you have an entry which would be lesser than the low of this. But then look at how the share has traded, or how the Nifty has traded. It did not go lower than the low of the gap opening at all. This is the first 15-minute candle. Now it did not go below the low, so no sell was triggered. Instead, it actually goes above the high of the candle, once again triggering a buy. So whether you have the downside gap or an upside gap, you can play it very nicely as a day trade. So opening gaps are very, very fruitful things for a day trader. He should be on the watch for it, and he should have these rules to trade it. It becomes a very profitable trade.
And so this is, you said it's a 15-minute chart spanning couple of days, and so you're seeing the gaps come up on each of those
yeah, this is at
days.
the open of any day. You know, here is where it had opened on the downside. Maybe the Singh Overseas advices were bad, or there was some localized bad news for that day. Prices actually open with a downside gap, shows zero follow through to the downside. If the market is not interested in going lower, why should we be interested in trading it short? Right? Instead, the market says to us that I actually want to go up, because it now starts trading above the high of the 15-minute candle.
So even though it's a gap down, you would still buy into that gap.
You would still buy into that gap, precisely, because the rest of the people are looking at the gap and trading short, and they would be on the wrong side of the trade, whereas you would look at the chart and be on the right side of the trade.
Interesting. And would you combine this with any of the other indicators that we did, that we've learned of in the past?
You could, but then the trading, let's say the opening gap is an independent trade by itself. You don't really need to, try and look at it in terms of moving averages.
Confirming it with something else.
Confirming it with something. It's a unique pattern by itself.
Right. Today we are going to once again focus on the different types of traders, different time horizons of traders. So if you're looking at day traders, swing traders and long-term investors, they really trade the markets very differently, as we've been telling you. While the first two love volatile or choppy markets, the latter actually prefer steady long-term trends and hopefully more on the positive side. But the truth of our markets is that they are increasingly being dominated by day traders. So let's understand a typical day trade strategy and contrast it with a trend following strategy. Doc.
Okay, I'll actually start off with longer term strategy, because the market has been going into a downtrend. Now if you look at the chart of Nifty here, what you have is a lower top, lower bottom formation, and a trend in it was actually triggered once a share actually broke. The Nifty actually broke the trend line here. When it broke the trend line here, swing traders or trend traders got a signal to sell this market short, and they could have held it short for a long period of, for a long and fairly sustained move down here. and you can see at the end of the chart that the downtrend is even now in force. But at the very least, this portion could have been got. But then what you see here is a lot of red candles. These are the days when the market has been very decisively down. But then you also have at this area with a lot of green candles, and these are the days when the markets have been up. Now, these set of red and green are not really of so much consequence to a trend trader who's actually looking to trade the full move. But these will be very, very significant for a day trader for whom each of these days will actually become a signal to go long and play it for the day long, even though the overall trend is on the downside. So using within the same trend, which was down from, let's say, end of April, 29th April or maybe 1st of May is when that trend line got broken on your daily charts. Now here is a trend which is around the end of May, from a bottom somewhere around the end of May. We have a nice rising trend which could have actually made a fairly decent amount of money for a day trader who would choose to go long in this using a simple higher top higher bottom setup and using a trend line like this for trying to define the supports against which he could again go long. So using just a trend line technique, you could be playing both long and short of the market.
So what's the duration of trade for the day trader? Because he needs to let some part of the day pass before he can actually spot that trend.
Yes, which is true. Now, but then you can simply solve it by looking at another trend line which you would draw on your resistance side. Like here you're joining two of these highs, right? So you have a resistance.
And what duration of time is that?
This is an hourly chart, so these are all hourly bars. So you're probably looking at about 2 to 3 days trade here. So you have a resistance. You had a downtrend which lasted for about 2 to 2.5 days, and then the markets actually crept out of that resistance trend line. So here is where the long trade is enabled here, and then once you have a long trade enabled, now you are on to a rise which is all higher top higher bottom formations. So simply using trend lines, which is as basic a technique that as you can ever get. We have spoken about more complicated technique, but this is also a very, very simple technique
that you
which
can
a day trader could use.
Right. Okay, time for a short break so you can digest all of that, think about that a little bit more. We'll come back, talk more about trend lines and define the differences once again between day traders and trend traders.